On October 10, 2025, the global cryptocurrency market endured a shockwave so profound, it registered as the single largest forced liquidation event in history. In just 24 hours, nearly $20 billion in leveraged positions were obliterated too, resulting in an estimated $560 billion being erased from the total market capitalization. Point one: this rapid, catastrophic digital collapse was not sparked by a hack or an internal crypto failure, but by a major strategic escalation in the US-China trade war. This is the anatomy of how geopolitical conflict translated directly into an unprecedented financial disaster in the digital asset world. Leading up to the crash, there was a fragile calm. High-level meetings were planned, specifically, a meeting between President Trump and President Xi Jinping at the APEC summit in South Korea. Point four: but that calm was violently shattered by Beijing's strategic first shot. China announced new, immediate restrictions on rare earth exports, requiring licenses for technologies used in their mining and processing. Why is this critical? China controls over 90% of the world's processing capacity for rare earths, the indispensable minerals needed for everything from defense systems to semiconductors. Beijing officially mandated these curbs to safeguard national security and prevent foreign military utilization. The response from Washington was swift and dramatic. President Trump, labeling China's move unprecedented, announced a massive escalation, a definitive 100% tariff on all Chinese imports. This duty, scheduled for November 1st, would be over and above any tariff that they are currently paying. This signaled a clear goal: rapid economic decoupling, shifting the conflict from trade management to technological warfare. Reflecting his immediate fury, Trump cast serious public doubt on whether he would proceed with the planned APEC summit, saying there seemed to be no reason to do so. The market panic. The geopolitical shockwave hit global equities first, confirming the severity of the macro risk. Wall Street saw an intense risk-off reaction. The Dow Jones plummeted 1.6%, a loss of 540 points, while the S&P 500 dropped 1.73% and the Nasdaq fell 2.4%. 0.11 for the Dow. This marked its worst performance since August. Market fear, measured by the CBOE Volatility Index, or VIX, jumped an alarming 26%. High beta, technology stocks, particularly exposed to US-China tensions, like Nvidia and AMD, suffered heavy losses. This confirms that investors were immediately pricing in a potential economic outlook worsening or corporate earnings retreating due to the trade escalation. Investors fled into traditional hard assets. Gold surged back above the $4,000 per ounce level 12, and silver prices also rose, reinforcing their role as safe havens. In a unique rally, U.S. domestic rare earth mineral mining companies, such as USA Rare Earth (USAR), saw their stocks rally 12.7%. This shows capital is betting heavily on the long-term strategic necessity of building independent supply chains. Critically, Bitcoin's strong correlation to falling tech stocks proved that the market, structurally, views crypto as a high-risk growth asset, not a geopolitical safe haven. The moment the tariff announcement hit, the market fractured. Data confirms that nearly $20 billion, or specifically $19.31 billion, in leveraged crypto positions were forcibly liquidated within 24 hours. Point two: the catastrophe impacted over 1.6 million traders globally, with more than $7 billion wiped out in the first hour of trading on October 10th alone. The scale of this destruction was magnified by the market's structural weakness: excessive leverage. Leading up to the crash, investor sentiment was signaling intense greed, peaking at 74 on the Fear and Greed Index. This structure was overwhelmingly long biased. Out of the nearly $20 billion liquidated, an overwhelming $16.686 billion were long positions. This imbalance maximized the damage when prices sharply reversed. Major cryptocurrencies saw heavy losses. Bitcoin plunged over 8% to stabilize around $111,000, and Ethereum dropped 12.7%. The altcoin market suffered disproportionately due to thinner liquidity. XRP nosedived over 22%. 14, and extreme flash crashes occurred in certain low-liquidity assets, such as Atom, which dropped from $4 to just $0.001, and SUI, falling from $3.40 to $0.56.3. This catastrophic order book failure highlights a severe lack of liquidity depth across many exchanges. The path forward. In the crash's aftermath, Bitcoin fell to a multi-month low of $105,000 before struggling to stabilize above the crucial $110,000 level. The price movement pushed Bitcoin's Relative Strength Index, or RSI, into deeply oversold territory, a technical reset that, while painful, can set the stage for a recovery. However, heavy resistance remains stacked around the $120,000 mark, and if the $110,000 support fails, analysts warn of a possible fresh dive toward the psychological $100,000 level. Not all altcoins failed equally. XRP demonstrated remarkable resilience in its swift rebound despite its initial over 22% plunge. Analysts suggest this resilience is tied to strengthening fundamentals and the long-awaited regulatory clarity that has de-risked the asset. This highlights a structural shift. Regulatory certainty is transitioning into a core defense mechanism against acute macroeconomic shocks. Market analysts have framed this massive liquidation as a necessary normalization, or the start of a crypto cleanse. By flushing out the excessive leverage and speculative, non-viable projects, the market may stabilize for a more sustainable, higher-quality rally in the future. The new normal. The crisis confirms that the fragile tariff truce is definitively over. The conflict has entered a strategic phase aiming for full economic decoupling, demanding substantial long-term capital allocation to construct independent value chains from mine to magnet outside of China. The $16.7 billion long liquidation loss represents a catastrophic failure of risk management in the centralized exchange landscape. This event provides immediate impetus for regulators to mandate stringent reforms on leverage limits and exchange risk protocols to prevent future structural failures triggered by external geopolitical events. Risk management is key. Bitcoin's failure to act as an immediate safe haven during the short-term shock confirms its current status as a highly leveraged risk asset. However, historical performance shows that Bitcoin tends to reverse these short-term dips faster than traditional equities. 20 Navigating this new normal mandates discipline. Investors must adopt a zero-tolerance policy for excessive leverage, integrate geopolitical risk tracking into their portfolio decisions, and prioritize assets that demonstrate genuine fundamental strength and regulatory certainty. The cost of underestimating the volatile convergence of Washington, Beijing, and leveraged global finance has been dramatically reset. Follow us for more content. Please subscribe.